Welcome to The Explainer. So, today we're talking about gold, and we're looking at it from two totally different angles. On one hand, we've got this big, powerful macro forecast that's predicting a massive launch. And on the other, a really specific micro-level trading strategy that actually exposes a pretty common trap. The cool part? By the end of this, you're going to see how these two views might just lock together perfectly. All right, let's jump right in. We are starting with a huge claim from financial analyst Patrick Montestioca. I mean, he's not just talking about a small rally here. He's using the term escape velocity, and that's a phrase that implies a breakout so powerful it completely breaks free from its current trading range. So you have to ask, right? What in the world is giving him that kind of confidence? So to really get this whole escape velocity concept, we've got to look past the day-to-day noise. The little price wiggles. This forecast isn't some wild guess. Nope. It's actually built on a really solid foundation of powerful, longer-term signals that are all pointing in the same direction. And that's the key here. The bullish argument for gold right now, it's not based on just one single thing. It's actually about this rare moment where cyclical, physical, and economic factors are all lining up. It's creating what a lot of analysts are calling a perfect storm for a major price move. Okay, so a great way to think about this is like there are different gears in the market's engine, right? Each one turns at a different speed. You've got your 30-day, your 60-day, your 90-day, and even that big 360-day annual cycle. Now, on their own, they just create little trends. But what's happening now, and this is what's so rare and so powerful, is that they are all turning upwards at the exact same time. And if you look back at history, this kind of synchronized alignment, it's been the starting gun for some of gold's most aggressive bull runs. And then there's this, which shows the pressure in the physical market. The term is backwardation. And for something you can store like gold, it's a really unusual situation. What it means is that the big players, they're willing to pay more to get physical gold in their hands right now, today, instead of waiting for a future delivery. It's just a classic textbook sign that real-world demand is seriously outstripping the immediate supply. So, layer on top of all those technical and physical signals this powerful dose of real-world uncertainty. Anytime there's a lack of clarity around key economic data, think inflation numbers, jobs reports, investors get spooked. And what happens when there's doubt? Well, they often run to what they see as the safety of gold. This just adds rocket fuel to a market that's already looking primed to go. Okay, but here's the million-dollar question, right? Even if you totally buy into this big, bullish macro story, how do you actually trade it? This is exactly where so many traders get stuck. They turn to these popular tools to try and time their entry, but more often than not, those same tools can lead them right into a trap. And one of the most common tools out there is the MACD. I mean, millions of traders use this thing. Why? Because it conveniently packages trend and momentum information all into one indicator. It's supposed to tell you when a trend is picking up speed or starting to fade. So the MACD itself has three basic parts. You've got the MACD line, which moves pretty fast, a slower signal line that kind of acts as a trigger, and then the histogram, which shows you the strength of the momentum. Here's the catch, though. A lot of traders just focus on one simple signal from it, and that's where things can go really wrong. So let's actually break down what this trap looks like. The classic textbook way to use the MACD is to watch for something called a zero-line crossover. But, as our second source is quick to point out, if you rely only on that, well, it can get really frustrating and expensive, especially in a market like gold. And here's the trap in action. You see the MACD line cross above zero. That's your textbook buy signal. So a trader jumps in thinking, great, the price is going up. But gold can be really choppy, right? It quickly reverses course, the trade gets stopped out, and it's a loss. This can happen again and again, and it's enough to drive anyone crazy who's just relying on that one signal. The folks at BK Traders put it perfectly. The indicator often fails on its own for a couple of key reasons. A lot of the time, the signals just come too late, after the big move is already underway. Or traders get whipsawed by all that short-term noise and choppy price action that gold is famous for. Bottom line, it's a signal without any context. But what if there was a way to fix this? A way to filter out all that market noise and only focus on the MACD signals that have a much higher chance of actually working out? Well, the source suggests a pretty simple but really effective addition. And the fix is actually pretty elegant. You don't get rid of the MACD. Instead, you pair its momentum signals with a 20-period exponential moving average, or an EMA. The EMA just shows you the average price over the last 20 bars, so it acts like a filter for the main short-term trend. And just like that, you're not just trading momentum anymore. You're trading momentum in the direction of the trend. That's a huge difference. So what this combination does is it creates a really clear 4-step process. Step 1, you use that 20 EMA to figure out your bias. Are we looking to buy or are we looking to sell? Step 2, you look to the MACD to confirm that the momentum agrees with your bias. Step 3, only when both of those things line up do you actually enter the trade. And step 4, you always manage your risk with a clear stop loss. This simple filter is all about keeping you out of those messy, low probability trades. All right, so let's zoom out for a second and bring these two different ideas together. We started way up high with this huge macro-level forecast for escape velocity. Then we drilled all the way down into a super specific micro-level trading strategy. So how do these two totally different views of the gold market actually connect? And this really lays out the difference perfectly. That macro cyclical analysis, that's your big picture weather forecast. It's telling you if the overall environment is good for a big move over the next few weeks or months. The MicroStrategy with the indicators, that's your GPS for right now. It's designed to help you time your specific entries and exits within that larger weather pattern. And this all brings us to the final thought. See, the big takeaway here isn't just that these two approaches are different. It's that they can be incredibly powerful when you use them together. Think about it. A macro backdrop of escape velocity could mean that those high probability setups you find with the MicroStrategy, they aren't just for small wins. They could be the entry points for a much larger move. So maybe the real key isn't finding that one magic signal. Maybe it's about learning how to use the right tool for the right job, using the big picture to build your case, and then using a disciplined short-term strategy to actually act on it.